Okay, good afternoon, everyone. For at least for those of you on the East Coast, for everyone else in the other time zones, good morning. My name's Ted Steinkamp, and I'm with Advanta IRA. I am one of the business development specialists here on the team. Been with the company since 2004. And wanted to take you through what I think is some really cool subject matter, particularly for those of you that invest in physical real estate through your IRAs or participate in opportunities where you can utilize your IRAs to invest in physical real estate. I'll be bringing on a personal connection of mine, both professional and as a friend, Nathan Webb. He'll be talking about drops and swaps shortly. But just wanted to present to everyone my contact information. You'll be seeing this slide again at the end. Just a quick note, though, about the webinar presentation. I'm going to ask that everyone hold their questions till the end. But while the presentation's going on, feel free to input your question into the appropriate field on your computer screen, and I'll ask the question of Nathan, and he'll provide you an answer. But just a real quick disclaimer about Advanta IRA, or that I need to present. Got to keep the compliance department happy here. Just 4 things that we don't do. We don't sell investment product, and we don't provide tax, legal, or financial advice. You'll need to approach the appropriate advisor for that. We're just not competent professionals in that area. But when it comes to self-directed IRAs, we are. So happy to answer whatever questions you have around those. Now, a little bit about Advanta IRA as a company. We've been around over 20 years. I have got 52, maybe 53 colleagues, perhaps another 1 or 2 because we are hiring. But everyone here is here for a purpose. They have a specific skill that they bring, whether they're an MBA, CFP, they hold the CISP designation, etc. We have over 13,000 unique clients that entrust us with over $3 billion that we have under administration. All the assets that are held here at Advanta IRA are secured because, 1, they're invested, and of course the uninvested cash balances, we maintain those over at an FDIC insured institution up to the applicable limits. And a little bit about our people. I mentioned I have about 53 colleagues here at Advanta IRA, but one very important function that my colleagues perform is the personal aspect to the business. As a company, of course, we're going to leverage technology as much as we can. However, this is your money. And when you have an important question to ask and you pick up the phone to dial, you want to speak with a live person. That's why every client of Advanta IRA is assigned to an account manager. So you have that live person to speak to. You don't have to sit there and tap digits on your phone to go through an automated attendant. That's not what we're about. We're all about, this is a people business, and that's what we're about. Now, just a quick thing. We get asked a lot, so I have a self-directed IRA. Well, self-directed or self-direction often is applied in many different ways. In our world, the connotation that we use is simply a tax-deferred account, a personal or a business retirement account where you can invest in different assets other than conventional things like stocks, bonds, ETFs, etc. Why do other custodians engage in that business? That is their business model. They don't engage in our business because it doesn't fit their model. We are a fee-for-service custodian. As I said just on a previous slide, we don't sell investment product. So we're not getting paid in that manner. The other custodians do. But one of the nice things about self-direction, you have complete control of how you invest your retirement funds and the investing decisions behind them. You can invest in alternative assets, obtain greater diversification within your portfolio. And of course, hopefully you want to achieve a little bit better investment return. We leave that up to you and your advisors to make that decision. But when you look at the alternative investment list I have on the slide, this is not as lengthy as what it could be. the creativity here is unlimited. As long as you're not investing in life insurance contracts or collectibles, there's no problem with the IRS. We see so many creative ideas here. We actually do an entirely separate webinar on the subject matter. Now, why would someone want to engage in self-direction? Well, first of all, there's a huge sum of money that has accumulated in retirement accounts, whether they're IRAs, 401ks, pension and profit sharing plans, etc. I mean, we're talking federal government accounting numbers. It is in the trillions of dollars. The total pool of assets out there, a little bit over 38 trillion. But when you look at what is concentrated into IRAs, it's over $13 trillion. And by the way, IRAs have only been in existence 50 years. So, and a tremendous source of capital. That's why individuals wish to tap their own to invest in it. The other reason, stock market fatigue. Look at the results, 3-5 year returns. You might be thinking, hey, I can do better. If that's the case, self-direction may be for you. And obviously, one of the big draws to investing through an IRA is the tax benefits. Tax deferred if you're a traditional IRA investor, tax free if you're a Roth IRA investor. And the types of accounts that we can handle over here at Advanta IRA through our administration and custodial services, really anything with the letters IRA after it. For individuals, it's going to be traditional Roth and inherited IRAs, education savings accounts and health savings accounts apply. And for those that are business owners, solo 401k is awesome when you know how to use it. Again, an entire subject matter we do webinars on. And then, of course, simples and SEPs for the self-employed and for the small businesses. And by the way, we also record keep the Roth versions of both of those plans. Now, opening up an account over here at Advanta IRA is very simple. It takes about 15 minutes to do a questionnaire. We send the documents to you through DocuSign for digital signature. That also includes the transfer paperwork to bring over money from another IRA or perhaps rolling over from a qualified employer's plan. And then when all said and done, we're ready to fund your investment. You just provide us the documents and the instructions and we'll take care of the rest. Now, getting into the meat of the matter here before I bring on Nathan, what we're going to be talking about today, and I'm just going to go through a couple of slides here to just do a very brief presentation of a couple of points, and Nathan's really going to carry the weight here from going forward. 1031 exchanges, they apply to real estate assets, whether you're talking about single family homes that are for investment, mobile home parks, real estate investment trusts engage in 1031s. We see it a lot with syndications and also too with individuals and groups that own commercial properties. So 1031 is for real estate only as it relates to this discussion. A couple of things when you structure the deal, and this is a point I want to bring up and not belabor through a whole bunch of slides that may not be applicable. When you're investing in real estate, I'm finding out a lot of investors and groups that structure the investments really are not aware. You can partner or commingle your money, IRA funds and personal cash. That means if you're putting together a deal that has just 3 or 4 individuals or 300 or 400 individuals investing. Some will want to invest with IRA funds only. Some will want to invest with their personal cash only. And by the way, it's not an all or nothing proposition. You can fund your investment as an individual using both sources. And this is really where it gets into the issue of partnering or commingling, as I like to call it. But one concept must be adhered to throughout the entire process, and that is splitting proportionately the income and the expenses. That is critical under the Internal Revenue Code. As long as you split those streams of income and expenses proportionately, no problems. When you don't do it proportionately, that's where problems may begin, and you're probably going to need some very good tax advice from there. Now, this event or this webinar will be recorded and placed on our website. It will also be placed on our YouTube channel, but you can also go to the AdvantaIRA.com website, look up the schedule of the upcoming webinars, podcasts, and we also have a blog on there if you wish to participate or even begin a discussion. So really, with that said, what I'd like to do is bring on Nathan.
Thank you, Ted, and thank you for having me. I do believe there is a ton of value with what Advanta IRA brings as well to the syndication space, and how those can be coupled with 1031 tax deferred exchanges and make a win-win for everybody, which is really my goal in everything. And I, like you, could probably talk about 1031s till I'm blue in the face, but it's really the creativity that is possible with a 1031 exchange, like a self-directed IRA, that really makes the juice worth the squeeze. And so that I'm really passionate about educating people about that. So thanks for giving me the opportunity to come on. Just a quick background on me. American Accommodators is a qualified intermediary, right? We have over 30 years in escrow and qualified intermediary experience. We're actually attached to a regulated escrow office in California. And so we have a lot of additional scrutiny that we come under as a qualified intermediary. But we do 1031 exchanges nationwide. I'm based out of Atlanta. And so I always tell people we do exchanges from coast to coast, West Coast, East Coast, doesn't matter. Between states, it's all very possible. Where my particular set of experience and skills come into play is that I've done a lot of real estate, including oil and gas, everything from multifamily, industrial, and retail. I've done a lot of syndications for other sponsors with other attorneys, putting these things together on just the 1031 side. And so I really bring in kind of this investors and sponsors and brokers mindset to how the 1031 exchange needs to be put together in order to make it a win-win for everybody. So I have a very wide background, but it's niche and specialized in the 1031 space and what you can do with it. But before I proceed with our full-on presentation, same disclaimer as Advanta IRA, I am not a tax or legal advisor. And so none of this should be taken as tax or legal advice. It's for educational purposes only, and that you should always consult with your tax advisor or legal attorney regarding any of those specific matters. To start off with the basics of a 1031 exchange, because we got to set the foundation. Some of this may be repetitive for some of you may know what this is, but for those who are just listening for the first time, understanding what the 1031 exchange is a basic concept, is what allows us to get really creative with it. If we can follow these rules, then we can really start getting creative with our deal structuring, which is what I really want to talk about. But a 1031 exchange is essentially just an escrow between transactions. You're selling a property, you're buying a property. If you're doing a 1031 exchange, you have this 1031 process with its own set of rules, right? That need to be followed in order for the IRS to say, yes, you did a fully tax deferred 1031 exchange. And so these rules are in black and white. They're not in gray. People always want to try to say, oh, well, you can do this, or no. The gray is outside of the 1031 exchange. It's very black and white. It is specific code to the tax-paying individual or entity, and that entity or individual must remain the same taxpayer during the entire exchange process. This is going to come into play later because we're talking about, oh, well, we want to partner with people and still do a 1031 exchange. How does that make any sense? Well, because we have to stay the same tax-paying entity during a 1031 exchange, there's ways that we can do that, which we'll discuss, but that needs to be the same during a 1031 exchange. When it comes to the investment property or real property involved, there is a stipulation that it must be property held for long-term capital gains purposes. So there's a timeline attached to it, but it must be intended for the use of business, investment, or income. That's what the like-kind property is. It doesn't apply to a personal residence. You don't need to do a 1031 exchange on a personal property, right? It does require a qualified intermediary or an accommodator to handle the funds between transactions that acts as that escrow. And then those rules have to be followed and reported. back to the taxpayer. The taxpayer is our client during a 1031 exchange, and then their CPA can fill out a form 8824. They send that into the IRS that says, hey, this exchange was successful or not based on the sold property, the purchased property, and the timeline. Okay, so that's the basics of a 1031 exchange. Where most people get really caught up is they get caught up in this, well, it's not like kind. I sold a single family house, I need to buy a single family house. I sold multifamily, I need to buy multifamily. That is not the case at all. Remember, I went back to, if you're selling any real property that's been held for income, investment, or business purposes, you can buy any other real property intended for income, investment, or business purposes. And so that can be a wide variety of things, including condos, right? You can go from multifamily to retail. You can go from self-storage into triple net lease properties. You can even go into raw land, that's intended for development. You can go into billboard easements, even leasehold interest, as long as they have a 30+ year leasehold interest still on the property, you can purchase that as a 1031 exchange or sell one and still 1031 exchange. And we can even divide up that real property into fractional interests that you can exchange into via tenants in common as a title structure or Delaware statutory trust as a legal structure. But like kind refers to any of that real property that's intended for income or investment purposes. So that's the first thing that starts to really open up the 1031 exchange on what's possible, is all of these different asset classes that make a 1031 exchange possible. Okay. The next thing is people think, oh, well, I'm just deferring capital gains. And yes, you are, but it is federal capital gains and state capital gains, which certain states, especially California, have some of the highest state capital gains tax brackets available. And those are tacked onto also the federal capital gains. So that is something that needs to be considered as well, besides just federal capital gains. The biggest, in my opinion, and oftentimes most hidden tax is depreciation recapture, because the IRS says even if you didn't take depreciation on a property, you still are going to owe recapture on that property. However, the 1031 exchange does defer that depreciation recapture because your basis travels with you when you do a 1031 exchange. Also, this nice little hidden net investment income tax gets tacked on to the end of that. If you're selling for value that's appreciated over $200,000 or $250,000, or you're making an income over that already, and you're trying to do an exchange, you're going to have an additional net investment income tax that's thrown on there. That's also deferred in a 1031 exchange. And so just realize there's a lot of things that the 1031 exchange takes care of, as long as you do it correctly and successfully and follow the rules. So it can be a real money saver, tax saver for you in the future. Now, some of the other rules that have to be for 100% tax deferral are that you do need to make sure that the property you're selling, right, and the property you're buying needs to be of equal or greater value. So think about price, right? If I'm selling something for $500,000, I need to buy $500,000 worth of value in another property, right? And I always say it goes back to value. It's not just price, because value can actually be sales price minus allowable expenses, or it could be your net proceeds plus the debt that you paid back as well. That would be your value. You also cannot take any cash from that. You can, right? But it wouldn't be tax deferred. You'd pay taxes on any cash that you took at closing. But in order to be 100% tax deferred, you need to transfer all of your cash that you received and replace all of that value that you relinquished in the replacement property, and you're 100% deferred. Boot is an industry term that we use that really just has to do with cash that you're taking up front, or cash that was left in your account that you're receiving at the end after you've already bought a replacement property. But it can also be any value that you didn't replace. Typically that comes in the form of debt, because you sold a $500,000 house, it had a $250,000 loan. If I just go buy a $250,000 house because that's all the equity that I had, you didn't replace your debt. Well, now you've got $250,000 in boot that's going to be taxable, but you've got no cash to pay that tax. So you always want to, people talk about replacing your debt. That's a good thing to consider. But at the end of the day, you can add cash. It doesn't have to be debt. you need to replace the value that you relinquished, equal or greater. So that's a real key. The next thing people tend to get caught up on is, oh, I only got 45 days to designate, 180 days to close. Yes, that is the truth, but 45 days from closing, you simply need to designate, which is saying you're writing on a piece of paper and submitting it to the QI that says, I intend to buy this, this, or this. And in that case, you would then get the remaining 135 days to actually close on that property, right? The catch with that is for the qualified intermediaries that we can only send funds to what you identify. So if you've identified something on day 45 and it's day 50 or 60 and you said, oh, I couldn't close on these or I want my money back, we have to give you every benefit of the doubt according to the IRS to say, this is what you identified, this was your intent. So we have to hold the money for the full 180 days at that point. But if you're not sure, like let's say you're at day 44 and even before midnight on day 45, you're saying, hey, I'm not sure that I'm going to do this. We can send you can not choose to not identify and we will send your funds back on day 46. And all you'll have to pay is the taxes that you would owe anyway. So a 1031 exchange is not a all or nothing. It's not a, hey, there has to be, I have to use all this money or I have to find a property. And, there's a lot of timeline crunch that a lot of people get anxious about. There are ways to do a 1031 exchange that's partial, and so only pay some tax, or you can fail it, but you're just going to end up paying taxes anyway, but at least your money's not tied up. The biggest help that I like to give to people in this is that because it's from closing date to closing date, you can actually line up your relinquished property and your replacement property, especially if you have a good broker that's working with you, to make sure that those closing dates line up pretty close. So you've already figured out what you want to buy. You already know what you're going to sell. You've got a contract. So let's put an extension on it. Hey, give me an extra 30 days to close so that you can get your property sold. And then your timeline can be really short. It can be a couple of weeks. And then you don't even need to identify. It's just a quick escrow transfer, closing. And as soon as you purchase the property, that's considered identification and you're done. So that's just one of the little helpful tips that I like to use. So it's not as big of a catch as I think some people make it out to be. But yes, the IRS did say there's a 45-day timeline that from closing that you need to identify. So just be aware of that and be prepared. And it's really not that big a deal if you are, right? When it comes to identification, there are some rules that the IRS has also put in place that basically, how I like to put it is, it keeps you from identifying the entire continental United States or MLS to say, hey, I'm identifying all this, and so you just get 180 days to buy anything. So they say the first rule that you have is that you have 3 properties that you can identify. They can be of any value, right? And you can close on any number of them, right? And that's fine, right? Most people go by the 3 property rule. That's probably 99% of the identifications that I do. For those that actually need to identify and close on more property, the first rule they have that comes into play is that the 3 property rule gets canceled out because I'm now identifying more than 3. So the IRS is going to look at the 200% rule, which says as long as you're not identifying more than 200% of your relinquished value. So if I sold for $1 million, I'm only identifying $2 million worth of property. You can still close on any number of those properties that you identify. It's just kind of restricting you from being able to identify all those different properties. So it kind of is a limiting factor, but it can help you to buy more. You can identify 6 smaller properties and close on 3 of them this way. If you happen to end up identifying more than 200% of your relinquished value, then the 95% rule comes into play, which means that you need to close on 95% of the identified value, or basically all of it. And so this comes into play when you're dealing with a lot of fractional interests, like oil wells and oil reserves, because you might have a list of 50 different wells and you're buying all of them, but you end up not buying one. Okay, not a big deal. But if it comes up to, doing most real estate properties, you're not going to run into the 95 or 200% rule. And so they're not really kind of rules that are there to help you get an exchange done better. They're kind of a limiting factor that the IRS has provided, while still allowing you to do some deals that just need to be done a certain way. So these are the identification rules specifically. There's a 3 property rule, 200% rule, and then 95% rule, if you're reading about those. Just in terms of a timeline, kind of how this looks visually, because I like to give visual examples, is during the contract phase of a sale, you have this timeline between open escrow to closing. During that time is actually when you need to get your qualified intermediary in place, because you have to sign a tax deferred exchange agreement. You're actually assigning the proceeds to the QI, and you're providing a notification to the buyer in this case that you're doing a 1031 exchange. That will also provide instructions to your closing attorney, title company, or escrow officer who's handling the closing, so that they know you're doing a 1031. They're able to adjust the settlement statement properly so that your CPA can read it and make sure that they also know that you're doing a 1031 exchange. And then they'll be able to wire proceeds directly to the qualified intermediary, because if you take the proceeds directly as cash, you will be taxed. Don't come and call me the day after closing or 2 days after closing and say, hey, I think I want to do a 1031 exchange now. Can I sign this all up with you? We can't do that. You have already been in constructive receipt, and so your 1031 exchange is null and void at that point. You have already received those capital gains, and so you have to figure out another way to maybe get some write-offs to not pay taxes on that, or we can go through recursion, which is a long, lengthy process that almost no one agrees to basically buy back your property and sell it again in a week. But all that to say, just get your qualified intermediary lined up beforehand, right? Now you're in the 1031 exchange escrow once you've closed, and that's when your timeline starts. So that closing is going to be your first day. Day 45 is when you need to work with your qualified intermediary, or work with us if you're working with us, and say, this is what I'm identifying, right? I would like to proceed, or I would like to not proceed. So here's my designation letter, signed and dated. And then you have the remaining time to actually close. So as long as you end up getting under contract, and this can happen way before day 45, you can be under contract on multiple properties. But to get to the end of the matter, as long as you are under contract, we're going to wire proceeds in. We're going to sign all the documentations you're going to have all the documentation signed so that we can coordinate with your other closing officer on the replacement property, and we'll wire those funds in for closing. And as long as that shows us being closed before day 180, you're golden. You're good to go. Okay, so that's what the timeline with the identification looks like from a very simple visual perspective, just for your reference. Okay, and this is for the same taxpayer, right? So if that's an entity, if that's an individual, spouses filing jointly, as long as those taxpayers stay the same, we can do this readily and easily. It's quite easy to do. What I like to do is talk a little bit about what's going on in the background. This is more of a tax advisor perspective, but as an investor myself, these are things that I'm always working around in my mind. What really happened with my property, and how do I know what my taxes are really going to look like, and if I actually need to do a 1031 exchange, right? And so the example here is, if I bought a property for $300,000, I put debt on it, I put a down payment on it, and it appreciated over time, right? So if it's a $300,000 purchase, it it went up in value to $450,000. Hey, I think I'd like to consider a sale, right? Take some of those capital gains off the table. But because I've paid down some of my debt, my equity's increased, this is great. But what you're not seeing on the background is that you've also been depreciating the property as well. And so we can take that appreciation and add in the depreciation, depending on how long it's been held or if it's been cost segregated or not, and come up with a total tax liability. And then based on your tax bracket, we can figure out, hey, this is how much you probably will pay in capital gains plus depreciation recapture. And just slapping on a blanket rate of 25% in this scenario, you're going to have a $233,000 tax liability, which means you're going to owe $58,250 in taxes. Would you much rather just, keep that rolling forward? In many cases, yes. In some cases where you haven't seen a lot of appreciation and you haven't held a property for a long time, that tax liability is going to be much lower. Might be something worth not doing a 1031 exchange on. However, if, like a lot of exchangers, you want to roll that forward and up, the benefits get really nice because you can transfer your equity and you can purchase a bigger property, which will actually increase your basis, give you more depreciation to take over the long term, which is an additional tax benefit. You can find good debt on it, or you can add some additional cash to it to make this investment worth it. And you can do an exchange where not only you're not paying any taxes, but you're increasing your basis, and you're most likely increasing cash flow as well, right? Because you're buying at a better cap rate, or there's been some value add that you can do, and you've already seen all the value in the property you relinquished. So it can really, really grow the portfolio just by exchanging. And so looking at it very simply this way, there's a lot of benefits besides just not paying taxes that you can receive by doing 1031 exchanges properly. So quick math, this is not, an exhaustive study, but if you're just taking kind of the same effects of, hey, I'm gonna invest $225,000, I'm gonna buy a $100,000 property, I'm gonna see 25% of appreciation every time. So I'm gonna add that to my exchange proceeds, and I'm gonna roll that equity forward, and I'm gonna buy something that I'm gonna, leverage at 75% loan to value. And I'm just gonna keep doing that. And if you do that, but you're gonna pay taxes and try to just reinvest your equity after the taxes are paid, right? Versus you keep rolling it forward in a 1031 exchange, do that same experiment multiple times, just 5 times, in this scenario of paying the tax after the sale over here. Again, that's like a 25% tax rate at the liability, but you just compound that 5 times. That's all this scenario has done. And by the end of that, you'll be rolling forward $1.6 million in equity, which can buy you $6.4 million, right? And you can end up selling that at a way better amount, or you're going to be cash flowing even at a modest 5%, after the next exchange. You're going to be cash flowing much better than if you were over here paying taxes every time you tried to exchange and reinvest in real estate, right? Because you're paying those taxes again and again and again, and then trying to roll that forward into the next property. You're going to be paying a lot more taxes up front, and you're not going to have as much to reinvest, but it's also going to severely limit the potential cash flow that you could make on any reinvestment, which is why most people are doing this, right? And so just something to consider from a very simple scenario. Is every scenario like this? No, absolutely not. The markets change all the time. They go bonkers, and you see a lot of appreciation sometimes and rent growth. Other times they're stagnant. And so it's just a simple way to think, hey, if I could do this every time, how beneficial is the 1031 exchange? And it can be very beneficial. So now to get a little bit more creative and to really drill down into drops and swaps for you IRA holders, to reiterate, the 1031 rules are very black and white, but we can go into the contracts and the agreements and the different structures that we can use that are still 1031 compliant, that can help achieve investment goals for everyone, and make it a win-win. So contract extensions are our first and easy one. Options and lease options, especially tenant and common options, are really incredible ways that I have seen people still be able to 1031 out of that option, or to have something under a lease to purchase option and get several years to buy a property while they're waiting to sell their portfolio in a 1031 exchange, but they've already got their replacement lined up. We're going to talk about TIC, or tenants in common, for drop and swap, and also partnering. And you can also exchange any seller carryback that you create. So as long as someone's willing to accept a note, that seller note on the other side, that you can actually 1031 exchange notes, as long as it's a note to the taxpayer who's also doing the exchange. And there's also ways to structure Delaware statutory trusts that can backfill debt and provide some of that debt up front, which is what tenants in common can also do. So there's a lot of, and I'm just scratching the surface here, but there's a lot of things that you can do that are totally 1031 compliant that can really make a deal even better for you, besides feeling like you're rushed and getting into a 1031 exchange where you're going to buy a property you don't really want just because you're worried about paying the taxes. Preparation is key. So going back to kind of, you have to be the same taxpayer. That's when a lot of people say, oh, well, I want to do a 1031 exchange into a syndication or a partnership or an LLC. That's not something you can do because that entity is its own taxpayer. And so I can't change my own entity, right? Not really. It has to be the same taxpayer ID at the end of the day, right? So I can't exchange into that, but also that's considered, your shares in an LLC are considered personal property, not real property. The LLC is selling real property, but your interest in something, trying to sell those shares and 1031 your shares, or trying to buy shares with 1031 funds, is not allowable because it breaches the real property versus personal property rules, and it's also often breaching the same taxpayer rules. However, you can exchange alongside a syndication, partnership, or LLC via tenants in common, or even a Delaware statutory trust. But a Delaware statutory trust is kind of a bit of a weird monster because it is personal property in a sense, but the IRS and the SEC have allowed it to accept 1031 funds. So it's the outlier, but for the most part, these are the biggest rules that come into play when people are talking about, oh, I want to partner with someone on my 1031 exchange. How do I have to do it? You can't go into the LLC, you can't go into the partnership, but you can go alongside of it. And the biggest way we do that is by tenants in common, right? So tenants in common is a title structure, and it's a way to divide up an entire property as fractional interests. So it's not saying I'm going to take 100 units of an apartment building and I'm going to buy these 25 and this person is going to buy 50 and they're going to buy these 25. No, you own 25% of all 100 units. You own 50% of all 100 units. And this has been, I mean, it's 100 years old now at this point. It was codified into US law in 1925. So this has been around a long time as a title and even partnership structure. And the reason this is relevant for 1031 exchanges and doing drops and swaps is because we're often utilizing this title structure in order to help things go forward and stay compliant in the 1031 exchange tax code. So a real simple example here is you could sell a $250,000 property and you can go into $1 million property as a 25% tenant in common owner with other people who are investing IRA funds, right? And maybe some who are just bringing in other cash or are providing a GP percentage of the total ownership. And you can split all of this up as tenants in common. The IRS says you need to have a tenant in common management agreement that outlines the percentage of undivided interest in each property and, you know, what the roles are, if anything, and making sure that you're compliant with the 1031. But if you have that tenant in common management agreement in place, the IRS says, hey, this is a safe harbor and you're good to go for your 1031 exchange as long as you can meet all of the other rules, separate taxpayer, equal or greater value, etc. So this is very possible with a 1031 exchange. And this is why it's also helpful to consider someone who might be investing in a deal with IRA funds as a separate tenant in common. And the reason for that is when it comes to doing what's called a drop and swap. So there are swaps and drops, but there's also drops and swaps. And so what dropping refers to is I'm going to drop from the LLC layer, right? We're all together. There's IRA funds, there's equity funds, there's all these other things. And we're all in this LLC together. But now somebody who may have a tax deferred account that they've invested with wants that cash and wants that return because they're not paying any taxes, right? But the equity investors may want to do a 1031 exchange because they have all of that depreciation and write-offs that they've taken. And so they really need to do a 1031 exchange. Well, the IRA people don't want to go with you in that 1031 exchange. So how can we do that? You can actually structure what's called a drop and swap. And that would be taking the investors who own a percentage of the entire LLC and dropping them into a tenant in common on title prior to sale. And then taking those who have held the title and have had the equity in the property, keep them in the same tax-paying entity, right? And they're allowed to exchange at that same value that their percentage represents, while other owners who just want cash at closing can take their cash at closing and they don't have to participate in the 1031 timeline. So real simple scenario is you've got 4 people in an LLC, 2 people want to stay together. The other 2 want their cash separately and they want to go their separate ways. So as long as, because this is a partnership LLC, you've got 4 people, so 2 are staying on board. So it's not a single member. You're not changing the taxpayer. It's still a partnership LLC. It's got the same EIN. Those 2 people stay in that LLC, but the other 2 who want cash, they can be dropped to their names. They can be dropped to an individual LLC because they're just going to get cash at closing, right? So we're just assigning the whole and the single member LLC into tenant in common interests that reflect that LLC ownership percentage. And then at sale, everyone can go their separate ways that way. So that is a drop and swap in essence, very simply put. This is also something that you don't want to try and do yourself. You want to have a competent attorney who's actually going to draft these documents and do this for you, right? This is not something your qualified intermediary does for you. The other way of doing that is you do a swap and then a drop. So if you're 1031 exchanging from a smaller property into a larger property with other partners, they're also tenants in common with you. You may say, hey, we want to convert this into, we want to drop into a full LLC or syndication together because it's going to be easier for distributions. It's going to make running and managing the deal a lot easier, and we're going to hold this thing long term. It'll make financing easier. There's a lot of pros to that. The cons are that you would have to then do a drop and swap again if you were planning to exchange out of it. So sometimes if it's a shorter term hold, just staying as tenants in common is way easier. But because it's just a little bit different management in that case. Technically, anytime you're actually dropping from tenants in common into an LLC, that is considered a 721 exchange because you are exchanging ownership of real property at the title level into operating units or shares of that REIT, fund, or LLC. So that usually falls under the 721 rule, which you don't need a qualified intermediary for because it's a trade, right? And it happens instantaneously. It's usually, if you're doing a typical 721 exchange, someone's offering you shares of the REIT, not cash. They're offering you shares for the property. So now you just have an interest in real property and you're being offered shares. So looks like a purchase via shares instead of cash, right? So that is in essence what a swap and drop does. So a lot of different ways you can kind of play these things back and forth across each other. And it's just helpful to know that there are a lot of things that are possible now with the 1031 exchange. You need to have the right structure, right? You need to make sure that your CPA kind of knows what they're talking about and doing. If they're going to be helping you on this, make sure that your sponsor, if you're going to be syndicating with people who, hey, I'm so-and-so is investing with IRA funds, another person is investing with 1031 money or their own equity, what do they want? Making sure that the sponsor knows how to set this up correctly from the get-go can solve a lot of headaches and problems up front. Having the right attorney makes all the difference. And then having, having the right QI or 1031 advisor that just can say, hey, it looks like this is what you're trying to do. This may be who you need to talk to, or this is maybe what you should consider, because everyone in the partnership has to agree, right? But once you kind of get all those pieces in place and understand what's going on, you can see the possibilities are vast to do a lot of fun things with 1031 exchanges, all right? So that is my quick and brief. Hopefully I didn't take too much of your time. There's certainly a lot more things that I could talk about, but I talk about this stuff all day long. So you can take down my information if you want and reach out to me with any questions that you have. I'm happy to answer them however I can, or refer you in the right direction for the expert that needs to help you in that particular area. But yeah, there you go. Were there any questions that anybody raised during this time? I know I went a little bit fast, and so I've got some time to do some Q&A.
Yeah, looks like we got 1 or 2 here. Let me just scroll through them. got one gentleman that's just asked if he could get a copy of the PowerPoint slides. And Nathan, if I may have your permission to do so, I will send those off to him after the webinar.
Yeah, I can do that.
Okay, great. And I'll get with you the contact information so you can interact with them as well. So yeah, as Nathan said, we're going to open it up to questions, but I do have one while we're waiting for questions to come on in, Nathan.
Mm-hmm.
As far as a group size, I mean, I see people putting together small groups, 3 to 4 investors,
Yep.
and we see syndications, 3, 4, 500 investors. I mean, some of these very large ones. Where does this best apply? And where is it most effective? Is there an effective group size for this?
Yeah, that's an excellent question. And that's something that I didn't mention, some of the limitations to tenants in common. One of them is that you're only allowed to have 35 members in a tenant in common structure. So that can be pretty limiting, right? It's relatively easy to set up. It's not a complex legal document to do a tenant in common structure. Again, you're kind of telling your escrow officer, title officer, I'm setting this up as tenants in common. I'm actually assigning a percentage of the property to so-and-so at closing. And then here's our tenant in common management agreement that supplements that closing. But you're limited to 35 people. So if you're looking at a much larger syndication where people, you've got 100 people who with IRA funds that want to get paid back immediately versus someone that, and you've got another 100 LPs that want a 1031 exchange with you because they've done different investments, then you can certainly look at making sure that those are subset within tenants in common and make sure that it's all allowable. Sometimes there's pass through for how many taxpayers are within those LLCs, so you just have to double check on that. But you could always go to a DST just for the sale. I have people who transfer from a typical 506B or C syndication, and then they'll turn it into a DST for the sale, which is still, you're kind of just doing a drop and then swap. But then you can have people 1031 out of that, and a DST a Delaware statutory trust will allow up to 500 people inside of that. So it's just a more complex legal document.
Okay. Now, I know we all like to look at the glass as half full, but what happens when it becomes half empty? Maybe something goes sideways with the transaction. Are there any pivot points to change structure, undo it? I mean, what might need to occur if that should happen?
Yeah, so you can, and there are different attorneys and CPAs are going to say different things. But you can, hey, we're all in this LLC together, and we're all deciding that we're going to sell this thing and go our separate ways, and we all want a 1031 exchange separately. You can still potentially do a drop and swap. I would just say you probably need to have that entity that you're planning to exchange on title for a period of time and title seasoning. The IRS really likes that, so that you can all go your separate ways accordingly. And you can always say, hey, we're going into something. I'm going into a deal as a tenant in common. I've had this recently where someone did a 1031 exchange into a tenant in common deal, an apartment deal, and they owned like 15% of it. And a couple years later, they were like, hey, I don't kind of like how it's being run. Can somebody just buy me out and exchange out of it? Yes, because they were still a tenant in common on title. So the parent LLC or the sponsor LLC just bought out their interest as a real estate transaction, not as a personal property transaction, a merger acquisition, and they were able to do a 1031 exchange out of that. So it's not like, hey, here's all the different ways that this is, a tenant in common structure or 1031 is going to solve everything. Just know that there's a lot of flexibility with how it can be worked into a 1031 exchange forward and backward, and you can do the swap and then drop, or you can decide to drop and swap individually. It's really kind of how the situation is working itself out that is most relevant.
Way cool. Now, another question, and this is a TED question. In all of our respective professional pursuits, we always have those interesting transactions, some of them rather comedic.
Yeah.
Maybe if you were approached one day by a script writer for a Hollywood film that you say, hey, I got a great story. Do you have any of those to share?
I'm sure I do. I'm
You may
questioning
not
right
want to
now.
share them.
I'm questioning right now if I'm legally allowed to share. Um,
You
what
can
I
always
find
punt.
most interesting is that a lot of people want to partner with their friends, or they want to partner with family, or it's really just a way of setting this up from the beginning. So one interesting one is that if people can grasp this, I'll try to make it plain. I mentioned that you can do master leases or lease to purchase, or you can put options on something. So had someone who they had an investor, and it can be an IRA investor, right? They didn't have money. They wanted to sponsor a small deal. Let's call it $100,000, right? So they said, hey, I found this deal. I'll manage it. I'll do it. I just don't have the money, right? And so they said, okay, the IRA investor said, I'll buy it for 100,000 cash. You're going to pay me first, right? We're going to set a lease rate, 6%, 8% as a master lease. Anything above that, you get to have as, kind of your operating, your upside for doing the management. And then I will also give you an agreement, an option to purchase 50% of the property at a value of $100,000. So $50,000 to buy it at that price that we bought it at. Well, a few years down the road, the property was worth $200,000. So when they went to sell it, the option holder, who was also the manager, exercised his option to purchase 50% of the property for $50,000 at sale, right? And the IRA investor got not only the proceeds from the option purchase, but from the upside of the sale. So what ended up happening for the IRA investor was that they got $150,000 from their $100,000 investment a few years later. The option holder, who did the management, who did the work, who was kind of the sweat equity and everything, they were actually able to 1031 exchange that option, right? Because they had material interest, they had the option held for a period of time. So they paid $50,000, right, to get $50,000 of equity in the upside, but 50% of 200 is $100,000. So they were able to go find a replacement property on their own. Now they had $50,000 to buy a $100,000 property or more, and that's what they went and did. So they 1031'd out of that, and
Okay.
so that is, that's contract level kind of creative partnering. That's 1031 exchangeable. But that's a fun, simple story that I'd like to share.
So if you do have any questions after digesting today's webinar, feel free to reach out to me. My contact information is in the bottom half of the slide. Happy to give you a return call. You can also reach out to me via email. But really, with that being said, thank you very much for a successful webinar. We filled up the time, lots of content. For those of you requesting the slides, Nathan or myself will get those out to you. And happy to speak with you about any questions related to this webinar or any other subject matter unrelated to it. So with that said, let's bring it to a close.